Hello, my Progressive Sisters Magic community. Today we're going to be going over lesson 8, which is going to be inquiring about indicators and oscillators. Now, I want to begin this lesson by saying these are two very important factors that you need to learn so that it can help you with your strategies, okay? Now, this is not meant to replace any type of strategy that you come up with or that you feel comfortable with, okay? Indicators are here to add on and to help the strategy that you already have existed inside of your trading plan, okay? So you're gonna take all the things that you've learned so far in lessons 1 through 7, and you're gonna take that knowledge and add on this escalator and these indicators type of knowledge so it can better your trading plan to ensure that you have the most successful type of trades. Now, when you're a trader, you're going to have good trades and bad trades. That means you're going to have wins and losses, okay? But we're going to try to minimize the amount of losses that we have by fully understanding everything we need to know about trading and trading strategies, okay? So again, this indicator and these oscillators are not meant to 100% totally wipe out your trading plan, okay? And don't always just use indicators and only place your trades based on those indicators. We need to place our trades based on everything that we've learned so far from lesson 1 through 7, and taking in this lesson that we're going to learn today for lesson 8, adding this into our trading plan so that we can be the best traders that we possibly can be, okay? We're trying to make money in the market and not lose it, all right? And the last thing I want to say before we get started with this lesson is that these things that I will be teaching in this lesson can be applied to any market. So if at any point you feel like you want to dive into futures or commodities or currencies or stocks, you can take the same exact information that I'll be teaching you in this lesson and apply it to those charts as well, okay? This is not specific to crypto, but it can be used in crypto, okay? So on that note, let's go ahead and jump into the first portion of our lesson 8. So I said all of that, but none of that may have made sense if you don't know what an indicator or oscillator is in the first place. You're probably like, so with that said, I'm going to go ahead and pull from our PDF file and give you the definition of an indicator, okay? Indicators are mathematical tools applied to crypto price charts. They take past data, price, volume, time, and calculate signals that help traders decide. Is the market trending or ranging? Is a coin overbought or oversold? Is momentum strong or weak? Think of them like weather forecasts. You can see the sky, price chart, but indicators are the radar and sensors that give more detail about storms, bullish or bearish signals. Why do we use indicators? Clarity. Raw price action can be noisy. Indicators smooth it. Confirmation. They help confirm chart patterns. Entry and exit. Indicators show potential buy/sell points. Risk control. Help avoid fear of missing out by waiting for confirmation. Indicators are not 100% accurate. They should support your analysis, not replace it. Always combine them with price action, candles, patterns, and volume. So there are many benefits to having indicators when you're trading. Some traders don't use indicators at all. They just go strictly off of price action and charts, while some others find that indicators are very useful when they have their trading plan, okay, their trading strategies. Now, one thing I can say personally is that indicators are great to use for beginners, especially if you're struggling with emotional trading, okay, emotional decisions. When you have these indicators, they are data driven, so it's taking out any emotions that you would have about the market, about this trade, and it's strictly giving you information based on data. So when markets are super volatile, you run the risk of a very high risk of making impulsive decisions so that you can get on this trade, okay? So that you can make money off of this trend that's going on right now. Now, if you guys haven't started trading yet, I'm going to let you guys know before you even start, fear of missing out will be your downfall. Okay, if you have a fear of missing out, you're going to place impulsive trades, you're going to have improper risk management, and it's just going to be horrible for you, okay? But when you have these indicators that are helping you with your trading strategy, not replacing it, but helping with your trading strategy, it's literally going to take so much emotion out of your trades, okay? So it's going to be less impulse and less predicting the market and more so data driven type of decisions, okay? So when you hear the word indicator, you can directly correlate that with a sense of also known as visual signals, okay? That's what these indicators are going to be. It's going to be taking the data, the price action, and everything that's been happening with that crypto coin, and it's going to be giving you a signal on what to do next, essentially, okay? So you should not only go based off of this signal. I'm just telling you guys that, but it is very helpful to have a direction that seems like it's the right direction that you should go in, okay? Instead of just entering a trade just blindly thinking, oh, this is gonna go up because the price looks good. All right, this is gonna go up because of news. Pause. One thing that you will learn as a trader is never to place a trade strictly based on news. There's no indicators, you're not looking at price action, you're not looking at price data, anything, you're not looking at trend lines. You're just placing a trade because of news that you're expecting to come out or that did come out. That is one of the worst things to do because news changes the market so frequently. The market can change based on news like 10 times a day. All right, I've seen it, especially with a volatile market like crypto. Crypto is one of the most volatile markets that there is. And so for you to be trading news and not doing any indicators, having a trading plan, trading strategy, or anything, that is going to be a downfall. Just like fear of missing out is a downfall, trading only news is also a downfall. I'm not saying don't trade news, but when you do trade news, look at the charts. Look at the indicators. They're there for a reason. Use them at your disposal. And the great thing about using these indicators is that it can be used to confirm a trend, okay? So if you're thinking that the market's going to go one way based off of news or based off of anything that you say, off of candlesticks, you can use these indicators and it will help you to confirm a trend, okay? Again, it's not always 100% accurate, but it's giving you some type of confirmation that you're going to need before you decide that you want to place a trade, okay? And not only is it going to confirm a trend that's going on, it's also going to let you know when a reversal is about to happen, okay? So it's going to tell you oh, this trend is happening right now, but it's about to reverse and something else completely different is about to happen. So you're going to want to know those things when you're trading, obviously, so that you can eat off of each price movement, okay? We never want to lose money because we didn't know which way the market was going. Not when you have trading strategies and indicators and price action data charts. No. So now that we have a bit of an understanding what indicators are and why we use them, we can go ahead and go into the different types of indicators. Types of indicators. There are two main groups. Trend indicators show market direction, which are moving averages, SMA and EMA, MACD, and Bollinger bands. Momentum indicators, which are called oscillators, show speed/strength of price moves, RSI, relative strength index, and stochastic oscillator. Volume indicators show how much trading supports this move, OBV, on balance volume, and VWAP, volume weighted average price. So in this lesson, we're only going to go over the moving averages, which is going to be the trending indicators for this lesson specifically, okay? So in part 2, we're going to go over RSI. Part 3, we're going to go over more. I just wanted to have a very in-depth lesson for each type of indicator so that you have a full understanding on how you can use these at your disposal to really help with your trading strategies. What are moving averages? Moving averages, MA, smooth out price data over time, making it easier to identify the overall trend. Instead of looking at noisy daily fluctuations, you can get a cleaner line showing where the market is heading. SMA, simple moving average, adds up the closing prices of a coin over a chosen period and divides by the number of days. Every day has equal weight, best for long-term trends. EMA, exponential moving average, similar to SMA but gives more weight to recent prices, reacts faster to sudden price moves. So a simple moving average is known as a lagging indicator, okay? So the reason why they call it a lagging indicator is essentially because it's taking these price data, these price points from such a big period of time, okay? So for example, a common one to do is from a 50-day period. So that means it's taking the price points from 50 days worth of data and it's going to be giving you a rolling average based on that, okay? It's going to give you the average, the moving average of this, okay? That's why it's known as being very practical for longer trends, okay? Identifying longer trends, okay? And then also on top of that, it's going to be used to identify any reversals on top of that, all right? So when you have this 50-day period and you have each data point, all of these data points are going to be treated equally, okay? So that's why when the market is volatile, the volatile price movements is not necessarily going to have an effect on identifying the moving average of this 50-day period or however many day period that you choose for your indicator. And that is because it's taking every single price point and treating them all equally, no matter how volatile or how involatile the market was. And that's how it's going to help you to identify trends, long-term trends, and it's going to help you to identify any type of reversals. So the time period on these type of moving averages for the SMA is going to be way longer than the EMA, all right? These SMA moving averages is going to have a lot slower reaction to any volatile price movements. Any sudden price movements that are happening in the market is going to have a much slower impact on the moving average when compared to EMA. So when I say the price data points, I am talking about the closing prices of each day, okay? So it's not just random points throughout the day of different prices that it hit. No, it's going to be the closing prices of each day, taking that 50-day period, taking each closing price of each day, and then making an average out of that, okay? So that essentially means adding them all up and then dividing them and then finding that average, okay? And that is going to be your SMA. Also, one very important thing when it comes to SMA is that it's going to be used to identify your support and your resistance levels, okay? So that is super important. We talked about that in the last lesson about support and resistance, so you guys know how important that is. This indicator right here, the SMA, is going to help you to plot and identify that onto your charts, okay? Which is going to be super important when you're thinking about placing a trade, because you want to know the support and the resistance levels, because when it moves past either that support or that resistance level, that's when you know that you're supposed to put your trade in, if it's going in the direction that you had anticipated it going in, that you planned with your trading strategy for it to go in, and then you can make an entry, okay? So you need all these confirmations and things like that, and I feel really that the SMA, this indicator, even though it's known as a lagging indicator, is one of the most powerful indicators that there are, honestly. Now, the EMA indicator is very similar to SMA, but the main difference between the two is going to be the recent price data points, as far as how recent those data points are going to be that they're going to be using, okay? So when you have the SMA, it's to identify longer trends, okay? It's about 50 days, 200-day periods, you have 20-day periods and things like that. With EMA, it's not like that, all right? They're very short, 5-day, 10-day, 3-day, things like that. So it's going to be more reactive to the volatility within the market and the sudden price swings within the market when calculating that average, because it is the most recent changes, okay? It's not taking a whole bunch of price data points, a whole bunch of closing prices, and then forming that average. No, it's taking recent data points, recent closing prices, and then giving you a moving average on that. So this is going to be used for identifying possible trends, identifying possible reversals, okay? And then also this can be used for a resistance or support level for you to put onto your charts. Both of these can be used for support and resistance levels when plotting onto your charts. But the difference when it comes to SMA is just identifying a trend that's already there, confirming a trend that's already there. When you have EMA, it's predicting a trend. It's showing you the direction that a trend can be going, possibly, all right? So the two are a little bit different. Both of them are very popular. On one side, you have SMA, which is going to be known as a lagging indicator because it's taking a whole bunch of information. And then you have the EMA, which is going to be known as a more recent type of indicator for more of real-time data, okay? So what's happening right there in that moment, if you're not trying to do a long-term trend trade or anything like that, you're trying to do a quick little day trade, EMA might be the better option. But if you're trying to hold a longer trade, you should really look at that SMA. Because EMA is so reactive and sensitive to these recent volatilities in the market and sudden price swings, it can give you false signals, okay? Especially when you had like a sideways market, when nothing really big is happening inside of the market, it can give you false signals. So it is best to pair this type of indicator with other indicators, like the RSI and other things that we'll get into in our next part of our lesson. But that's the only kind of like negative thing about EMA, is that it can definitely give you some false signals. I mean, all of these type of indicators, don't get me wrong, can give you false signals. They have the probability and the possibility of giving you a false signal. But I will say with EMA, it's much more likely to happen than it is with the SMA, because it's more recent price data and they are going based off of volatility and certain price swings, like sudden price swings. While SMA is more so here for the long run, long-term trends, not really paying attention to all the drama that's going in the market day by day. It's giving you just exactly what happened within that specific time frame. So speaking on time frames, while it is effective to use it on the 1 hour time frame for this EMA indicator, it's best to use it on the 4 hour plus time frame to give you more reliable trends, more reliable confirmations. Okay, so you can use it on the lower time frames, but it's best to use it on the 4 hour plus time frames, just so you can have a solid confirmed type of visual signal rather than a false breakout or a false signal. Now let's get into exactly how traders use the SMA and the EMA indicators. Trend identification. Price above MA is bullish, uptrend. Price below MA is bearish, downtrend. EMA/SMA crossovers, the golden cross. Short-term MA 50-day crosses above long-term MA 200-day, and that is a bullish signal. Death cross. Short-term MA crosses below long-term MA, which is a bearish signal. So when you have the golden cross, that is going to be a bullish signal, because that means that the shorter term MA is going to be, which is like a 50-day period, is going to be crossing over. It's going to be above the longer term MA, which is about 200-day period. Okay, so let's go ahead and look at this. So that essentially means that it's trending upwards to the upside. It's like saying, okay, well, we're going to have some possible upward gains. Okay, we're going to have some possible gains within the market, because the market is showing that the trend is going up, because the most recent data points, even though it's on a given 50-day period, even though it's such a big large number of days, it's still recent, more recent than the 200-day pattern. Okay, the 200-day price points moving average that they have. So when that is above that 200-day average, that means that, okay, you know, the market's going up. Recently, as of these recent price points, these recent closing prices, the market is going up. Now, it's going to be the total opposite for the death cross, okay? So that means that the most recent price points, the most recent closing points are below the 200-day type of period that they have. So the 50-day period is well below the 200-day period. So the longer trend that they have is above essentially the newest trend that they have. So that means that it's signaling a bearish type of market. And essentially all that means, and when they say a bearish market for this death cross, is that they're anticipating even more potential further losses in the market. Okay, so when you have the golden cross, it's anticipating gains in the market, and then the death cross is going to be potential losses within the market. So even though in the example that I just used, I used a 50-day period for SMA and a 200-day period for SMA, it does not have to always be that. And actually, it will not always be that. You could have a 15-day and comparing it to a 200-day, or a 15-day and comparing it to a 25-day, okay, and things like that. So you don't necessarily always have to have this same exact time periods on these for it to be accurate. So as you can see with the example that we have on the PDF file, when we're talking about the different type of SMA and examples on that, it's showing you different like price periods. Okay, so we have the 15-day, I know they have the 10-day and things like that. So as long as whatever is the longest period, okay, compare that to the shortest period. And if the shorter period is above the longest period, that means that it's a bullish type of signal. If the shortest period is below the longest period, that means it's giving a bearish type of signal. I have a kind of really weird example, but I think this example is really going to get the point across, like really confirm what I'm talking about. So we're going to talk about the weather. So you have a weather forecast. So for the past 30 days, it's been like 80 degrees, okay? So it's been on the warmer side. But for the, like, as far as all the days put together and then creating an average based upon that, all right? Now, on the upside, there are the past 10 days. You know, that average of the past 10 days has actually been like over 100 degrees. Okay, so when we see that the past 10 days, the most recent data points are above what we already have, we can already expect that the weather's probably going to go up even more. It's probably going to get even hotter. Okay, but let's say if we had a 30-day period of weather data points and it was 80 degrees, but then the 10-day period of data points that we have was like 60 degrees. You know, that's below the average that we have already set for the 30 days. We can go ahead and assume, because for the past 10 days it's been 60 degrees, that it's going to be even lower than that higher weather forecast that we had at first. Okay, so that means it's probably going to go lower if it's below. So 60 degrees from 80 to 60 within like 10 days, probably gonna go lower. From 80 to like over 100, probably gonna go higher. I hope that that was a really good example. I believe when I was saying it, I'm like, wow, this really makes sense. Okay, all right, my ladies, I was like, this actually makes perfect sense. But again, if this did not make sense, not even just this part, but if anything in this lesson didn't make sense, please leave a comment. Please type a question on our school app, and I will make sure to have it answered within 24 hours. I say 24 hours, but it'll probably be answered within like an hour. Honestly, because we're very active on our platforms and we want you guys to have an adequate, you know, form of communication for your educational platform that we have. All these lessons are for you guys. So that is going to end our part 1 for this lesson 8. And on our next video, we're going to be talking about RSI, which in my opinion is basically just as important as moving averages. I'm just saying. So you need to come back for that lesson. We are going to have that lesson next. But that is end for today. Go ahead and watch the lessons before this lesson so that you can really understand what I'm talking about when when I go and talk about RSI. It's just really important that you do that, you guys. And if you haven't already, please open up your trading account, a paper account, which means there's no real money in there. And let's just work on marking up our charts. Let's go ahead and play with those indicators, okay? You go in TradingView, you're going to have those indicators on there. You're going to go in your brokerages, you're going to have those indicators on there. So all you got to do is go looking for it and you shall find it. All right, but that is it for today's episode, and we will be back for part 2.